Recessions are a scary time to live through. The markets are dropping, spending money is low, everybody's out talking about the catastrophe the recession is. But that doesn't mean that your wealth has to suffer too. Hey, good to see you again. If you don't know, my name is Evan. This is My Money Marathon. I make content centered around personal finance and beginner investing. I'm also very active over on Twitter and Instagram and TikTok, links below in the description. But in this video, we're going to be discussing how you can continue building your wealth even through a recession. I know we've been hearing this for years, but many experts out there and key statistics are indicating that if we're not already in a recession, we're likely going to be hitting one very, very soon. These key indicators include lower job availability, rising costs of goods and services, and lowering purchasing power of consumers. Whether you want to take these indicators as meaning we're in the middle of a recession, panic right now, or you want to take it as we are likely going to be heading into a recession in the near future, preparation is never a bad idea. In fact, there are even some ways to build your wealth even more than you could during positive non-recession times. Here are my top 5 ways to continue building wealth through a recession. My first tip is to keep your current place of employment. Now, raises and promotions are okay, but assuming the job you're at is decent to begin with, switching jobs is just going to be a risky endeavor. Having consistent, reliable income through a recession can be a genuine lifesaver. During a recession, job availability is going to be lower, so not only is it going to be harder to find another job out there, but it's going to be harder to find a quality job, and it may even be harder to keep. The caveat to this is that you can upgrade from within your company, and that's going to be less risky because they already know you and they're less likely to lay you off if you've been there for a while versus switching to another company and being the new kid. My second tip may sound silly, but stocks are on sale. As long as it's the same old company that you've known and loved for years, continuing to buy a company during recession for a lower cost is nothing but getting that stock on sale. As long as the company hasn't significantly changed and it's only dropping due to an overall market recession and not due to issues within that company, it's a great deal. What you'll do by buying at a discount is you'll lower your average cost that you pay for that stock, and when the market and that company eventually recover once the recession is over, you will supercharge your returns and earn far more than you would have if you had left your average cost high like it was before. My third tip, similar to the last one, is to prioritize retirement accounts. Getting stocks on sale is even more powerful when you include tax-free growth in the long time horizon that retirement accounts generally focus on. Many retirement accounts out there, like 401ks and IRAs, grow tax-free, and this means that any gains you generate on your investments are not taxed. And if you had gotten those stocks at a discount during a recession, you're only going to see even more gains than you otherwise would. Plus, since most people are aiming to retire decades away from now, that long time horizon means that you can afford to take the short-term risks of a recession, knowing that in the long term, you're going to get those gains back. My fourth tip is to diversify into real estate prior to a recession happening. Real estate can provide consistent rental income even through a recession, making it very powerful for diversifying your portfolio. Keep in mind, though, that property values will likely drop during a recession because consumer buying power is dropping as well, so selling probably isn't the best idea at the time, but rental income tends to stay pretty consistent through a recession, meaning you can continue to generate the same rental income as you were prior to the recession. This can be a legitimate lifesaver in hard times during a lapse in employment. My fifth and final tip is to avoid knee-jerk reactions in your investments. Even though the market is liable to drop during a recession, it has survived over 150 years of world wars, health crises, horrible presidents. Whatever it's going through now, it will recover again. The only people whose investments suffer throughout a recession are those that panic sell when they see things drop or attempt to time the market. Those things are more than likely going to lead you to losing money, whereas continuing to consistently hold through the drop and plan for the long term will generate you long-term returns. If you enjoyed this video, dropping a like and subscription below would mean a huge deal to me, and if you want to see more content like this, check out my links below. Other than that, see you next time.